The affordable housing crisis is not only making it tough for people to buy homes in Arizona, it's also putting tremendous stress.
And good evening, I'm political editor Dennis Welch. This is Politics Unplugged, and earlier in the legislative session, Arizona lawmakers had failed to reach a consensus on how to address the state's housing crisis.
Arizona desperately needs affordable apartments and homes, and it shouldn't be a partisan issue.
You've been eyeing the Arizona real estate market, thinking of investing in a dream home. But hold on. The ground beneath your feet might be shifting faster than you think. Home prices are tanking, and entire neighborhoods are being left in the dust. Are you about to get caught in the storm? Do you know which areas are most at risk? The warning signs are flashing red, and experts are sounding the alarm. Let's take a closer look at the 10 Arizona markets that are crashing fast, and what you need to know to avoid getting burned. Here's the inside scoop. Number 10. Phoenix. Phoenix, often the hub of first-time homebuyers and growing families, has seen an intriguing shift in 2025. The median home price currently sits at $460,087 as of June 2025, which reflects a modest year-over-year increase of 1.3%. While subtle, this growth indicates resilience in demand, even as inventory struggles with balance. At the same time, the average home value is reported at $416,780, showing a slight 4% decline compared to last year. This dip presents opportunities for buyers seeking affordability in select neighborhoods. However, it's worth noting that homes are typically listed at $474,983, suggesting there's still confidence among sellers in setting higher asking prices. Inventory in Phoenix has remained consistently tight, with around 7,683 homes available for sale by mid-2025. While these figures reflect only a small dip of 0.2% compared to May, it marks a decline in market activity, and roughly 60% of homes sold last month transacted below their original asking price, signaling a price correction trend. Interestingly, the median days on the market have stretched to 67 days, a notable rise from last year's average of 52 days. This increase points to buyer discretion, as rising interest rates in 2025 influence household budgets. This is why prospective buyers are now making more calculated choices before closing deals. One standout statistic shows that 31% of homes sold in Phoenix moved off the market in under 30 days, revealing pockets of demand that still thrive. With its growing suburban sprawl, bolstered by developments in Alhambra and North Mountain, Phoenix retains an appeal for those seeking space without losing access to economic hubs. However, sellers pushing for top dollar may have to be patient, as evident from the numbers reflecting longer sales cycles. Number 9. Scottsdale. Scottsdale is painting quite a different picture. Known for its high-end neighborhoods and resort-style living, the Scottsdale market thrives on luxury appeal and exclusivity. The median home price here hit an impressive $900,000 in May 2025, marking a sharp 9.1% increase over the previous year. This statistic underscores Scottsdale's ability to withstand broader market dips, especially with a focus on affluent home buyers and buyers from out-of-state metros like Seattle, Los Angeles, and Dallas, who continue moving in to escape their local affordability crisis. Inventory, however, remains a challenge. The number of homes for sale sits at just over 3,000 as of June, leaving buyers with limited room for negotiation. This scarcity further inflates prices, as sellers hold the advantage in Scottsdale's competitive environment, where homes are typically sold at 4% below asking prices on average. That said, homes here are taking slightly longer to sell, averaging about 62 days on the market compared to 60 days last year. Scottsdale's list-to-sale price ratio also reflects a mild decline, falling to 96.3%, possibly hinting at price fatigue amongst buyers. Neighborhoods like Grayhawk, Desert Highlands, and DC Ranch continue to showcase million-dollar listings and record-breaking price tags, especially in the Pinnacle Peak Heights area, where homes trickle into the market with valuations exceeding $2 million. Additionally, Scottsdale's rental market further emphasizes its exclusivity with an average rent of $2,139, $70 higher than the national average. Demand for short-term rentals in some areas also plays a role in sustaining these high rents, adding an element of competition between buyers seeking vacation properties and long-term residents. Number 8. Tucson. Tucson. Known as the soul of the Sonoran Desert, this quirky college town with its rich art scene and outdoor adventures has always had a loyal fan base. But 2025 has brought some less than stellar headlines for its real estate market. Home prices here have dropped by 18% since early 2024, according to the latest data. Why? Overbuilding during the pandemic plays a huge role. Developers went all in, betting on the influx of people moving in from pricier states like California. What they didn't expect, though, was that population growth would stagnate after the initial migration wave passed. Combine that with skyrocketing mortgage rates, now averaging 7.6% for 30-year fixed loans, and you've got buyers putting the brakes on quicker than a car spotted by a state trooper on I-10. Suddenly, demand couldn't keep up with supply, and just like that, Tucson became a buyer's market. It's unfortunate for sellers, but if you've been dreaming about owning a home here, now's the time to pounce. We're talking about beautiful mid-century homes in historic neighborhoods like Sam Hughes sitting on the market for months. Talk about bargains! And then there's the issue of the city's job market. Manufacturing and healthcare are big players, but they recently took hits. Boeing scaled back operations, and a major local hospital announced layoffs last year. Fewer jobs mean fewer people looking for homes. Add seasonal tourism still recovering from the pandemic slump. And it's clear why Tucson's housing market is feeling the heat, or should I say, the chill. If things keep going this way, you'll have your pick of desert retreats for well below asking price. Number 7. Mesa. Next up, Mesa. Arizona's third largest city and a once hot market has also made the crash list. If you were house hunting here a couple of years ago, you'd remember desperate bidding wars that ended with homes selling for $50,000 over the list price. Fast forward to 2025 though, and it's a totally different story. Median home prices in Mesa have nosedived about 16% in the past year. The culprit? Oversaturation. Mesa's boom years spurred massive residential developments as whole neighborhoods seemed to spring up overnight. On paper, it made sense. The city was a magnet for retirees and remote workers, lured by the low taxes and sunnier than sunny vibes. But with the rise of cost of living concerns, many of those retirees and remote workers are now eyeing states like Texas, where housing is still comparatively cheap but offers better overall affordability. Meanwhile, Phoenix's rapid growth has begun to overshadow Mesa, siphoning off potential buyers who prefer bigger city amenities. Another factor? Rising utility costs. Look, summers in Mesa regularly hit triple digits, so air conditioning is practically a life or death matter. But Arizona Public Service, APS, increased electricity rates last year, and homeowners are feeling the pinch. Remember when your mom always yelled to shut the fridge door because of the electric bill? Well, here, that's happening on a whole other level. No wonder some folks are thinking twice before buying in a city where bills can melt your budget faster than an ice cream cone at Pioneer Park. Finally, Mesa's public transportation, or lack thereof, adds insult to injury. With gas prices holding steady above $4.50 per gallon, long commutes around this sprawling suburb aren't winning any popularity contests. It's hitting the market hard, especially for newer developments far from the city center. If this trend keeps up, expect even more for sale signs popping up around town. Number 6. Chandler. Chandler has long enjoyed its reputation as one of the East Valley's crown jewels. With its tech-heavy job market, great schools, and family-friendly vibe, it was the place to be back in the early 2020s. But as 2025 rolls on, things don't look quite so rosy. Home values here have dropped by a significant 14%, and inventories are climbing faster than the summer temps. One big problem? Chandler leaned heavily on its high-tech industry to drive the local economy, especially big names like Intel. But in late 2024, Intel delayed expansion plans for its massive semiconductor plant, citing global economic uncertainties. Overnight, that put a dent in the confidence of potential homebuyers, especially since a lot of Chandler's newer developments cater to tech professionals. With fewer high-paying jobs coming to town, demand for these upscale homes is evaporating. Then, there are the HOA fees. Chandler is teeming with master-planned communities, where residents enjoy amenities like pools, gyms, and golf courses. Sounds great, right? Not when those HOA fees are soaring, leaving residents questioning whether the perks are really worth it. Add property taxes that are higher than in Mesa or Tucson, and it's starting to feel more like a financial squeeze than the suburban dream. And oh, how could we forget water concerns? Arizona's ongoing battle with drought and water rights is not just a hot topic, it's a genuine issue. With Chandler's reliance on water-intensive amenities like lush golf courses, coupled with rising water costs, many buyers are second-guessing whether settling here makes sense. It's a city that's fantastic in so many ways, but the housing market? Well, it's now a buyer's market. Number 5. Gilbert. Gilbert remains an attractive option for families and professionals, known for its excellent schools and suburban charm. However, the market has seen some fluctuations recently. The median home price has slightly changed, sitting at $585,718, a 1.5% increase year over year. Even though this might indicate stability, homes have taken longer to sell, with the average days on the market rising to 62 days, up 33% from June 2024. This change reflects a more cautious buyer sentiment, likely fueled by rising interest rates. Interestingly, inventory levels are falling, with 1,460 properties on the market, a 5.3% decline over the past month. Fewer available homes may favor sellers, yet buyers still hold some leverage since 68% of recent sales closed under the asking price. This state of affairs could be a game changer for families looking to negotiate better deals, especially in neighborhoods like Ashland Ranch and Spectrum, where median values reach $667,000, $289,000, and $519,065, respectively. Another standout aspect is the segmentation by property type. While one-bedroom homes saw a slight dip in prices, down 2.4% to $249,000, larger properties appear to maintain more stable demand, with four-bedroom homes ticking up marginally by 0.8% to $650,000. Rental trends mirror this pattern, as average rents in Gilbert stand at $2,176 per month, slightly higher than the national average, further amplifying the city's appeal for investors aiming to tap into rental income. Gilbert's steady reputation aligns with its well-planned community feel. While competition among home buyers has eased compared to previous years, sellers still perform fairly well, with homes fetching a solid 99% of the listed price. The future of this market depends largely on interest rates and whether the inventory remains limited enough to maintain upward pricing pressure. Number 4. Flagstaff. Flagstaff, known for its cool climate and proximity to natural wonders like the Grand Canyon, offers a more niche market. Yet 2025's trends reveal slight shifts in buyer and seller dynamics. The median home price here is $750,000, marking a 1.1% decrease from the prior year. While small, this decline signals a balancing act underway, fitting for a market navigating between affordability concerns and steady demand. The market currently leans in favor of buyers, with nearly 8 months of inventory, which is well above typical seller market thresholds. This abundance has led to longer sales cycles, as homes now spend around 47 days on the market, edging upward from last year's 40s range. For buyers, this creates opportunities to negotiate prices, especially as sellers face pressure to offer incentives. Areas like downtown Flagstaff continue to hold their charm, but newer communities face stiffer competition to draw attention. When analyzing affordability, the sold-to-list price ratio of 99% indicates most homes still sell near asking, but the abundance of inventory leaves room for flexibility. This is particularly true as the number of listings continues to rise. Year over year, the city experienced a 109% boost in inventory. Buyers ready to relocate from metro hubs might find Flagstaff's open houses less crowded, making it an excellent time to consider investing here. Another noteworthy trend is the variation across price ranges. High-end properties in Flagstaff are seeing fewer offers compared to mid-range homes, as a growing segment of buyers focuses on single-family homes below $800,000. Given current conditions, strategic upgrades or price reductions could benefit sellers, while buyers keep an eye on market timing to secure the best deals. Number 3. Sedona. Sedona's breathtaking red rock vistas and reputation as a haven for luxury buyers position it as one of Arizona's premium real estate markets. This year, Sedona has seen the median home price climb sharply to $905,000, a massive $110,000 increase, or 13.9% year over year. Though some might perceive this as daunting for buyers, it showcases Sedona's magnetic appeal to affluent individuals seeking a lifestyle upgrade. Despite the rising prices, homes linger on the market longer than before, averaging 67 days, up from 52 last year. While longer days on market can imply weaker demand, Sedona's case is different. Here, the delay often represents high sticker prices and selective buyers spending more time to ensure unique properties meet their expectations. Bear in mind, Sedona remains without significant inventory expansion, keeping supply-side constraints high. Another pattern shaping the market is the steady interest in short-term rental investments. Given Sedona's perennial draw for tourists, many luxury homes are being snapped up, not just for lifestyle reasons, but also as lucrative Airbnb opportunities. These dual-purpose properties, which are vacation homes doubling as income generators, bolster the city's appeal to cash buyers typically insulated from higher interest rates. Notably, areas like Uptown Sedona and Oak Creek Canyon have emerged as hotspots for luxury estates hovering well above Sedona's median price. These neighborhoods not only offer unparalleled views, but also feature amenities for the discerning buyer, such as infinity pools and eco-friendly builds. Despite the high barriers to entry, Sedona's prestige ensures it remains a top choice for those willing to splurge. Number 2. Prescott. Prescott has always been a magnet for retirees seeking tranquility and a slice of Arizona's mountain charm. But the real estate market there, it's in a freefall. What's causing this? For starters, the aging population that once drove Prescott's housing demand is holding onto their homes longer than expected, eroding the turnover rate. That would be okay if new blood were rushing in to take their place. But rising interest rates have put the brakes on that. Younger families and first-time buyers are taking a hard pass on Prescott, mainly because the costs, both of purchasing a property and maintaining it in an area prone to wildfires, are simply out of reach for many. Want numbers? A typical Prescott home was priced at nearly $500,000 by mid-2024. By early 2025, that figure slid down by more than 10%, and the trend isn't looking to reverse anytime soon. Then there's Prescott's dependence on retirees' fixed incomes. Retirees love stability, financial and otherwise. But the rising cost of living, coupled with declining investment market returns, has made even the most stable retirees jittery about splurging on a new home. Inflation has hit everything from groceries to utilities, making Prescott less appealing for those hoping to stretch their dollar. With fewer buyers entering the market and inventory slowly piling up, home prices are feeling the pinch. The number of homes on the market rose by about 15% year over year as of spring 2025, signaling clear trouble ahead for sellers. Sure, the mountain scenery is gorgeous, but Prescott's susceptibility to environmental conditions is yet another reason for its struggling market. Concerns over wildfires have skyrocketed in the past 2 years, pushing up insurance premiums to eye-watering levels. For a mid-range home, you're looking at an added annual cost of around $4,200 in wildfire insurance, double what it was just 5 years ago. This has caused a surge in deals falling through as prospective buyers balk at the hidden costs of making a mountain retreat their forever home. Buyers are starting to realize that the price tag on a house is just the beginning of the financial commitment. And here's the kicker. Local job growth isn't exactly wowing anyone either. The economy in Prescott has leaned so heavily on retirees and the service industry that when either falters, as it has recently, the entire market quakes. Real job growth in 2024 sat at a limp 1.2%, trailing the state average. Without thriving industries to attract younger professionals, sellers in Prescott are stuck waiting for buyers who simply aren't coming. Sure, it may still be a great weekend getaway, but most folks aren't itching to sink their fortunes into second homes when cash liquidity feels like king these days. Number 1. Yuma. Now, Yuma. What's not to love about a city with sunshine practically 330 days a year? Well, a lot if you happen to be tied to its real estate market. Yuma's downturn isn't just a hiccup, it's a free fall akin to a summer monsoon storm. And here's why. The agriculture-based economy that Yuma relies so heavily on is in rough shape. Water rights disputes and drought-like conditions have put a massive strain on agricultural production, shrinking the job market faster than a cactus garden under a hailstorm. That instability means fewer job opportunities, fewer people moving in, and fewer buyers shopping for homes. Who wants to buy in a town that might feel like it's withering economically? Affordability also comes into play. And while Yuma hasn't had the sky-high prices of cities like Phoenix or Scottsdale, it's been climbing steadily, at least until recently. To give you an idea, the median home price peaked around $320,000 in 2024, but as of early 2025, it's been on a steep decline, crawling back into the $290,000 range. That doesn't sound like a huge dip, but in a market as tight as Yuma's, such shifts cause panic for both sellers and buyers. Sellers panic because they're losing value quickly, and buyers panic because no one wants to buy a home today and watch it decrease in value tomorrow. Then we've got the investor phenomenon, if you can call it that anymore. Yuma drew a small but eager pool of would-be investors excited to tap into its rental market. However, with rising interest rates and stricter regulations on property management, many of these investors have pulled the plug. Some sold at the height of the market in late 2023 and have since opted out entirely, leaving rental inventories thin and prices ultra-volatile. Meanwhile, new construction projects planned for 2023 and 2024 are currently either stalled or operating at a snail's pace, leading to half-finished builds scattered across Yuma like some bizarre dystopian art exhibit. And yet, Yuma's aging housing stock also isn't doing it any favors. About 60% of homes in the area are more than 40 years old, many in dire need of renovations. Unfortunately, renovation costs have ballooned thanks to supply chain inconsistencies and labor shortages that began in 2022 and have yet to resolve. Picture this: buying a $280,000 home from the 1980s, then having to fork out $80,000 more to bring it into this century. Not exactly the most appealing scenario for today's cautious buyer. With little new housing stock and existing homes requiring financial and emotional investment, it's no wonder Yuma's real estate market is struggling. CTA. If you enjoyed this video, let us know in the comments section down below and turn on your notifications to know when next we upload. See you in our next video. Bye-bye.